Think about this. If you bought a stock at $30 per share at the price, and you held the stocks for 3 years, at the end of year 1, the price was $35. Congratulations, you have a capital gain, right? The asset value went up. And at the same time, you received $1.2 dividend per share, okay? So there's an important concept here. I want you to write this down. Holding period return, HPR, okay? Holding period return. Sounds exactly as what it is. You hold at the beginning like 0 and you sell it, for example, or you sell it at the year 3, and there's going to be an ending price, which is P1, and beginning price P0, right? And also some cash flows. The cash flows, periodic cash flows for stock, in this case, would be dividends, right? And the holding period return is the sum of your capital gain, which is the price change, and also your yield. This is called the yield, right? Dividend yield in this case. Okay, so let's calculate that. First of all, the capital appreciation at the end of the year 1 from $30 to $35 is going to be what? Is going to be the difference between $35 and $30 divided by the initial price, right? Just like what you see right here. So this gives you 16.67%. The current return is the dividend yield, equals the dividend you got divided by, again here, your initial investment, not the ending price of the year 1. Okay, so that gives you 4%. And your total holding period return is simply the capital gain or loss. This could be loss, by the way, okay? It doesn't have to be positive. Sometimes it's negative. And your dividend yield, which is 20.67%. Just for example, like if you own Apple stock, right? Or IBM, or some of the oil companies, right? Like ExxonMobil or Shell, then you will get periodic dividend payments, usually quarterly, right? So this is exactly what you would receive if you invest in stocks that pays dividend. So once we have gotten this, understand this is the holding period return, we can simply drag this down, okay? So drag this down. This is negative 11.43% return is the results of the price dropping from 35 to 31, okay? The current return, of course, dividend was bigger and the price was lower. That's why the current return, the dividend yield is higher, right? So you see that you're holding for 3 years, not every year is a positive return. This is actually quite the norm on the stock market, right? Of course, when you have a hot sector, like during the past few months, you will have the tech sector, right? The technology or anything related to online shopping or in-home entertainment, in-home fitness would be the hot sector, and also the vaccine, right? The pharmaceutical sector is also a hot sector. Then you'll probably have a continuous bull market for that period of time. But most likely, when you invest in long term, right, you will have sometimes what we call the correction here, right? Right, so that's the first example, very simple, okay? So let's go to the second one. So this, we are getting into risk, okay? We are getting into risk now. Of course, we're gonna learn 2 terms, the variance and the standard deviation. So sigma is the standard deviation, right? So that's the square root of the variance. But first of all, these formulas are here as a reference for you, right? So, but let's first understand what this really is. So let's say you are going to do this one investment, okay? And of course, not every investment, not every trial, not every project in life is going to turn out to be exactly what you want, right? Like, rainbows and then, sweet pies and everything falling from the sky. You will have the scenarios where everything goes as you expect it to be the best scenario, and you have good scenarios, and you have okay, and you will have a what we call recession, right? Excuse me. So in this case, the probability of you having the best scenario is 10%, and then good is 40%, and just so-so, then your return is 5%. And if there's a correction if there is a recession and is minus 25%, right? So you have two standalone, A, B, C, or X, Y, Z. So A, B, C, and X, Y, Z here, right? I want you to write this down, you know. Make a judgment right now, just write down, you know. A, B, C, and X, Y, Z, which one is riskier? Which one is riskier, right? So write that down. And then, so that if you look at these numbers, right? The range, this is from negative 25% possible, right? Possible outcomes to 30%. And this is from negative 1% to 10%. So by looking at these numbers, we'll know that XYZ is most likely less risky than ABC, right? But then how do we evaluate the level of risk? Because you can say this obvious ABC is riskier than XYZ, but some of the stocks or investments that they have very close numbers kind of mixed up, right? So just by looking at numbers, sometimes you will not be able to figure out which one is a better investment in terms of risk management. So you actually need to calculate the risk, and risk is measured by standard deviation. Okay, so now I'm going to show you guys step by step how to get there. So first of all, when you have these, what we call the possible or probable outcomes, you got to calculate the expected value, right? What is the expected value? Is, again, this very important term, weighted average. Weighted average, okay? So using weighted average, what do? We use to calculate weighted average, we use the function sum product, right? So the probability is the way because they add up to 100%, multiplied by the possible outcomes, right? The outcomes of ABC. So that gives us, for ABC, you're expected to get about 7.5% return, 7.5% return based on this, right? So that's the weighted average of all the scenarios. And we can do the same for XYZ. So that's going to be sum product of the possibilities or the probabilities and the outcomes of XYZ, right? Wait, hold on one moment. Let me correct the typo, sum product. There you go, 3.4%. Now we know the expected value. The variance is essentially the squared differences, okay? Write this down, squared differences of each probable outcome and between each probable outcome and the expected value, okay? So this is what we're gonna do. Equals the expected outcome of boom minus the expected value. And we're gonna put F4 to lock the cell, okay? And then square it, right, to the second power. And simply, we can do this, drag this down. For XYZ, we do the same. Equals the probable outcome, 10%, minus the expected outcome of XYZ. And then we press F4 to lock it, okay, to the square. So that's why it's called squared difference. And we drag this down, okay? So now the variance becomes what? Becomes the probability, you see this formula, the probability weighted squared differences, right? Because the difference here, square difference is 5.6%, but there's only 10% chance that it's happening, right? So what is the variance overall, the variation of the scenarios overall? So what we're gonna do is we do the sum product again, right? Of the probabilities and the squared differences, just like what this equation tells you, okay? So that gives you 3.26%. And let's do this again, using sum product, calculate the probabilities, and use this to multiply all the squared differences for XYZ. And then Excel will sum it up. That's why the function is called sum product, right? So you see that this variance is much, much, much smaller. However, that's not the risk we're talking about. The risk measured as standard deviation is the square root of the variance. So we're going to use the function square root, SQRT, write this down, right? So this is what you're going to use in Excel. SQRT, the square root of the variance. So this gives you 18%. And if you drag it to the right, so let me explain. Let's pause here for a moment. This is what we're looking for, the risk measured by standard deviation. What does 18.6% mean? It means that you have expected return of 7.5% if you're holding ABC, right, with these 4 probable outcomes. But you're likely to get more than that. Is that possible? Of course, because you can get 30%, you can get 20%, right? And then this has a 10% chance happening. This has 40% chance of happening. Can you get lower than that? Of course, because you can get 5% or 25%, right? So on average, you have this range of 18.06%. So if you add this one, we call the one standard deviation, right? This is the one standard deviation, 18.06% to the 7.5. This gives you 25.56%. If you subtract 18% from 7.5%, this gives you negative, right? Negative 10 point, about 11, right? 10 point, like 50% of that. So between this negative 10.5% and 25%, you have 65% chance, right? That's 65% down. The 65% is the distribution percentage, where you have 65% chance of getting a return that is between negative 10.5% and 25.56%. Okay. Again, so this is the technical side. We just need to understand what it is, because we can always use Excel to calculate that, right? But understand why we're doing this, right? We're not just simply crunching numbers. When we compare investments, right? You can do emotional investing. You can do emotional trading. Like, I believe this company, I'm gonna buy the stocks. And I believe in, for example, Tesla. Well, I believe in Apple. I love Apple products. I'm just gonna buy Apple stocks and hold it for 5 years, 10 years. Are you gonna make money? I think most likely so, because the company, I'm talking about Apple, right? Because the company now has a large, just look at the business model, look at their income statement, look at their revenue growth, and also their product line. Hey, there's a pretty decent probability that this company is going to keep doing well, right? But then it doesn't mean that Apple is the best stock on the market, is the best investment for your money. Like, you put 100% of your money in Apple. I think it's probably not the case, right? So how do you compare when you have more than 3,000 stocks on the market and you have more ETFs than ever, a mutual fund to choose from? Then it comes back to measuring the expected return and the risk. Remember at the beginning, I mentioned this example. I asked everyone, are you willing to risk $1 to make potentially $5? Most of you said yes, right? So this is exactly what it is. Now we're calculating. So what is your risk? You're risking about 18.6%, right? 18.6% as one unit. But what is your potential return, guys? What is your potential return? Only 7.5%. I'm talking about average. Can you get 30%? Yes, but there's only 10% of chance of you getting that. Okay? So you're risking this much to get how much? 30%. But with stock, or let's say investment XYZ, your average return is how much? Is 3.4, right? Expected return. But how much are you risking? You're risking 3.14%. Okay? So there goes the very important concept here. Write this down, Sharpe ratio. This is one of the most popular term and one of the most valuable term you can use for risk management. And of course, you're gonna see this in the slides too, as I told you guys to read through the slides, 25, 26 slides, and that's how you study this chapter. I'm gonna talk about the chapter, demonstrate how we do it, but you're gonna read that 26, then it has some text explanation of what the risk, or what the return is, and the standard deviation and variance, and then what's the Sharpe ratio, right? But understand, like, why do we do all this? Is because this is a tool to help you make decisions let's say, hey, stock selection, right? Or portfolio selection, portfolio evaluation. That's what it is. Okay. So Sharpe ratio is what? Is your expected return over your expected risk, right? So you're measuring the ratio between the return and risk. And of course, in the slides and textbook, you will see that it's the return minus risk-free, right? Of course, but here we are comparing the two. We know the risk-free is the same for both of the stocks here, so we don't actually need to factor the risk-free return rate in, right? So simply what are we going to do is use the expected return divided by the standard deviation, which is risk. So the Sharpe ratio for ABC is 0.24. The Sharpe ratio for XYZ is 1.08. If it's greater than 1, it's good. You always want to choose the one with the highest Sharpe ratio, right? But the things here's the catch though, okay? If you want to be aggressive, you want to make more money, potentially, right? And you only have these two choices. If you want to make more than 10% a year, potentially, right? You got to take risk. No risk, no return, okay? Sometimes there's low risk and high return. That's exactly what we're looking for, the asymmetric risk-reward ratio, right? But in this case, A, B, C, X, Y, Z, none of them look attractive. Neither of them look attractive to me because their Sharpe ratio just really, really suck, okay? However, if I had to choose between the two, I want to choose XYZ. Why? Because remember the 3 rules I talked about to how to build your wealth, okay? If you remember, you can write this down in your notebook, right? If you remember any of them, the first one is do not lose money. Exactly, right? If you lose 10%, let's say if you lose 50%, it takes you 100% to get back to where you were. That's why it's important. That's why, risk management is very important, because that's why over 90% of retail traders blow up their account within 90 days, because there's no risk management. They're hoping for what? The best outcome, the 10% right here, but they get this negative 25. And in most cases, they get it what? Negative 100 instead of negative 25, especially when they use margin, right? And we'll go through the margin examples again after this, okay? So Sharpe ratio, remember. So in these two cases, but again, going back, right? I was saying, if you want to make more than 10%, and there are only 2 choices, well, you gotta take ABC, because in XYZ, the best scenario, you're gonna get 10%, right? So there's no way you can make more than that. So understand that, but at least you want to do this with a calculated risk. So how do you implement this in your trading and investing? Good question, huh? You know this stock can potentially get you 30%, right? ABC. That's awesome. But you got to set your stop loss order. You got to set up your line where there's the line that you're going to sell. You're not going to wait until the stock drop to more than 25% from the price level when you get in. Does that make sense, right? So if it drops a little bit, it's not going the direction you want, you can hold it a little bit. But if it's going too far, you're going to stop loss, you're going to sell. I'm talking about trading, okay? I'm not talking about trading, frequent trading. So that way, yes, you lost some money, but you lost not 25%, you probably lost only 5% of your money, right? But then you bet on other things, you use the same strategy, right? If you were risking losing 5% instead of 25 because you set up the stop loss, okay? Stop loss order. If you're risking negative 5% to have a potential 30% return win, is that a good deal? Of course, because now the risk reward ratio is 1 to 6, right? 1 to 6. So that's why I do trading, you got to manage. These are the tricks, right? You say, well, I sold it, it could go back up. Yes, it could, right? You also could not. You may go down further, right? But out of 10 trades, if you always use 1 to 5, 1 to 6, if you just are right for half of the time, you make money. If you are right 3 times, you wrong you were right 3 times, you were wrong twice, you still make money. And if you were wrong 4 times and right for just 1 time, you break even if the risk reward ratio is 5. So who can stay in the game longer? A person has risk management, has stop loss, risking 5% to get 30%, or risking 10% to get 50%. Make sure the risk reward ratio is 5. B doesn't have a plan, will hold until it goes back up, just to wish the stock will go back up. Which person would make money, right? You can write this answer down in your notebook. Now, just think about it. And then, isn't that the same how we manage our risks and the choice in life? Think about it. Okay. Right. So I will leave it as that, and let's go to the next one. So this one is going to be a portfolio. See, we're actually halfway through, right? The portfolio here, you have A, B, C, D, E. You have 5, let's say, stocks, right? And the amount right here, the market value simply means how much money you put in, right? So $20, we don't know how many shares, but it means you put $20 on stock A, okay? Beta, let's look at the beta here. So this RM means market return. This risk-free means RF means risk-free return. Beta is the co-movement, the magnitude of co-movement between one stock and the market. So A here is 2.2, right? It means it's positive 2.2. It means the market returns 10%. Then how much is stock A's return? Is going to be 22%. That's why the beta is 2.2. Let's look at E. This is negative 0.5. It means if a market goes up 10%, the stock will actually drop 5% because it's negatively correlated with the market. So the bigger the absolute value, I repeat, the bigger the absolute value of beta is, the more volatile the stock is, or the higher the volatility is, where you will see this variance or standard deviation being higher. Okay, so now we're getting these terms connected with one another. Okay, so some of you probably wonder, why the heck do we have E right here? Why do we want to have some stocks have a negative beta? Well, this is how we diversify, right? What if the market goes down? What if all your stock is positive beta and the market goes down? If the market goes down, like in March, market goes down, everything goes down, and you just lose all the money. But if you have a hedging, what I would call this hedging, right? You have something that moves against the market. Then March, when if you put that in your portfolio, then the market went down, then you made more money. Okay, you made more money. Just like the bottom, the end of March, my portfolio actually went up. I mean, I shared this with you guys, I think during the first week and second week, right? Is how you use, for example, put options, and also even if you don't feel comfortable with options, you can also buy the ETFs that is betting against the market, right? So I give you guys that example. I just want to make that perfect clear. Again, here, I'm not giving any investment advices here, right? This is the pure educational purpose, just like you attend any other workshops, right? Or lessons or seminars or, class. You make your own decisions, right? But there are tools out there. The point is, there are tools out there can help you hedge the risk of potential high volatility, right? So think about this, right? We have election coming up. Okay, and then next year, what is this thing? What is the government's policy? What is the situation going to be for, what we are facing right now? Is the market still going to be volatile, right? I don't know the answer. I'm asking you guys because you have learned all these tools now. Of course, we're going to learn more, But ask these questions while you read news, right? While you see the data, think about it. Because only when you are able to think independently, make your own judgment, you become the master. Otherwise, I know, right? There are people out there who just want to be told what to do, which is fine, right? Because we have freedom of choice. But if you always need somebody to tell you, buy this stock, hold this long, sell it, then you need an advisor, right? Is the advisor always right? I am not sure. As data shows, the average performance of mutual fund managers suck. It's less than S&P 500. It makes you wonder why you give those people money. They charge you about 3% on average every year. Okay, so the key is you learn. Now you're learning all these stuff. You gotta train yourself to have original thoughts, right? Of course, you can share, you can talk with others, but not being influenced by someone who has absolute certainty, or someone who claim they have more experience than you, without demonstrating to you they have a consistent performance for an extended period of time. Okay, as I've told you before, somebody can show you their best trade and then portray themselves as the best trader with investor in the world, but they don't show you their losing trade. I guarantee you there's no one on this planet who has been doing trading consistently don't have a single losing trade. They always do. Okay. All right, so let's calculate CAPM. What's CAPM right here? This this little equation right here. So CAPM is the capital asset pricing model, but understand this. This is the keyword is, write this down, expected. This is the expected return of the stock based on the prediction using this model, using the correlation between the stock and the market, right? And using the risk-free and the market return. So let's do that. So the CAPM equals what? Equals the risk-free, which is 2%. Let's lock that. Plus the beta, which is 2.2 of stock one, multiplied by the difference between market return, lock it, because market return, risk-free return doesn't change, minus, right? D37, which is the risk-free rate. What does this 28.4% mean? It means that stock A expected to make 28.4%, right? If you hold them. So let's drag this down. Let's see CAPM. So the expected return of the stock is listed right here. However, this return in column E, these 5 numbers are the actual return, or what we call the HPR, the holding period return, right? So if you compare this return with the CAPM, you know that this return is less than expected. So it's what we call underperformance, right? So if it's over, like this 8.5 versus 8, so if you expected to get 80%, you got 90%, then you outperformed, right? So we're going to use the if command here. If the actual return is greater than the expected return, then we call it overperform, right? And if the actual return equals the expected return, we call it par, or else we call it underperform. Okay, so that's it. So you drag this, you will see that you have par, you have under and overperform. And now you know the performance of each stock, then we can calculate your portfolio, because you have a portfolio where you invested $81,000 initially. So what is the weight? The weight is simply what? How much money you put in each stock versus your total investments. Again, your total investments, we put an F4, we press F4 to lock it. So this means you put about 25% of your money in stock A. And you drag this down, you will have this weight, how much money you put in each stock. And the weighted return is simply what? Is the weight multiplied by the actual return of the stock. Okay, so that gives you 3.7%. You can drag this down. The portfolio return, though, there are 2 ways to calculate it. We have used some product. Let's use that again. You have 5 different investments, and this gives you what? your actual return multiplied by your weights, right? So what's your portfolio return? Again, weighted average return. So this gives you 13.12. What sum product does is it does the product between return and weight for each stock, and then it sums the 5 product up, right? So there's 2 steps in one. Since we have already done the first step, we can simply do the sum. This is what I call the manual calculation because it takes 2 steps. Sum all the weighted returns, and it will give you exactly the same number. Okay, so that's what weighted return is. What is your portfolio beta? Again, it's going to be the weighted average beta, which means you multiply the beta array with the weight. Okay, so your portfolio beta is a 0.98. I want to say this here again, right? So we are not just crunching numbers. Your portfolio beta is 0.98. It means it's a good portfolio because your portfolio just with 5 stocks, not 3,000 stocks, your beta is less than 1. It means your portfolio return is less volatile than the market. It's safer, is less risky than the market. So this is what we call good risk management, good diversification. Okay, so that's a very important concept. So now you know portfolio's beta, like this equation tells you, right, how to calculate the portfolio beta. It's the weighted average beta of each stocks. What is a portfolio CAPM? Using the same equation, right, equals the risk-free return plus the beta of the portfolio, which is 0.98, multiplied by the difference between the market return and the risk-free return. So this gives you 13.78. So the actual return is less than the portfolio CAPM, means that the portfolio underperformed the CAPM, right? But I can tell you this, guys, the CAPM is dead. Okay, that's in the research and academia. Everybody knows this is the model somebody invented in the 60s. Okay, it's like what, 60 years ago. Okay, but just understand what it is. You still go when you go to Yahoo Finance, when you use your broker, your brokerage account, when you log on those, you know, what I call the information panels, and you see the trading stuff, sometimes they give you a beta, right? Tell beta. It just tells you whether the stock is more or less volatile than the market, right? And of course, the smaller the beta is, it means it's less volatile, right? Less risky. Okay, so let's do this one. This one is going to be really, really quick. So I'm going to demonstrate to you guys, because we have already learned how to calculate the holding period return, the CAPM return, and how to do the performance, right? Underperform, overperform. Here, I'm going to demonstrate when you have a large amount of data. Well, here, I actually don't call it large, right? Because you can have 100 stocks or 1,000 stocks in your portfolio. Like S&P 500 actually tracks 500 stocks, right? But how you can efficiently use Excel. So it's sort of like doing Excel. And for some of you who attended the Excel class before, so you will probably, I hope you actually still remember how to do this, right? So I'm going to demonstrate that, you know, that Excel can help you really speed things up and then do it in a way that is faster than you could have ever thought. Okay, so let's do the holding period. So the ultimate goal for this exercise here, and of course, this is on your assignment, right? So what we did exactly your assignment 3, which is doing in a week. You're going to do this holding period return for each stock, right? So what is holding period return? Simply, one moment. So simply, it's the sum. Let me highlight this area. So let's go back to the review. Holding period return is the sum of the capital, is the capital gain or loss versus the capital gain or loss plus the dividend yield. So let's go there. So first, your current yield, which is dividend yield, equals the dividend over the initial investment, okay? Not the ending price when you bought it in 2017, okay? So that gives you, let's change this to a percentage, 2.71%. And your capital gain or loss is what? The P1 ending price minus beginning price divided by the beginning price, okay? So that gives you what? A percentage, 12%, and you can increase the number of decimals. So what is your holding period return? Is the sum of the current yield and the capital gain or loss. So that gives you 14.32. 32%. What is CAPM? Equals the risk-free locket plus the beta of the stocks multiplied by the market return locket, because we're gonna use we're gonna use the same formula we created and drag this whole thing down. So you only do it once, okay? And then press F4 again, close it down, and let's do performance. If the holding period return is greater than the CAPM return, expected return, we call it over. If the actual return equals the CAPM return, we call it the par. Otherwise, it's under. There are only 3 possible scenarios, right? That's why we use 2 layers of if. So this one's over. What is the beginning value? This is the beginning value for your investment equals the beginning price multiplied by number of shares you got. Because if you got 300 shares of A and you got at the price of $25.5, right? And you're gonna spend how much? You're gonna spend, let's see, you're gonna spend $7,644. What is the ending value? The price, ending price, a year later, multiplied by how many shares you have. So this gives you 85. You made money, right? What is the way? Well, you want to know, if you want to know the way, you first got to calculate everything, right? So now we have this, we have these calculations for stock A. We can do what? Simply drag this down, okay? So now immediately we have the calculation for everything, okay? And of course, this is the portfolio sum. Remember, if we want to calculate the portfolio return, let me move to the right. That's going to be the sum of everything here, okay? From M5 to M23. And then we can drag this to the right again, right? And this gives you the ending value. Like so basically you invested close to 300K in July 2017, and then a year later, now your portfolio value is 317, right? So your gain is about $20,000, not bad. $20,000 from about 300K, I would say that's 1.5% return over a year, right? I mean, it's underperforming the market. That's why I recommend, like buy S&P 500, because you don't even need to select the stock, just enjoy the market. Just invest consistently. If it drops, then you buy more every month, buy the same amount, right? It's called a gradual investment, just like how you invest in your retirement account, right? So you will have a lower dollar cost average because when you are keep buying when it's low, right? Smart investors at the late March, when it went down about 40%, they were all in. They were all in. And of course, there were these people I told you guys, right, who said that Armageddon's come, is going to drop further, right? Those people are what I call clowns. Okay, those people are financial entertainers. Financial entertainers. They always compare, hey, this is like this is the bull market right now is like 1999. It's like, it's not like 1999. Nothing is ever the same with what happened in history. Just think about it. History does repeat itself, but it's never the same. It's a spiral pattern. It's going up or down, right? And the people can compare this to 2008. It's not 2008 financial crisis. So if you still seeing those, watching those news and articles, they are simply entertaining you, disturbing you, and then make you want to subscribe their services so they can get more ad revenue. Just stop reading it, okay? My advice is very simple. It's a waste of your time and attention, okay? So now your ending value is this. This is good performance. You made money, right? So what is the weight? The weight is how much you invested in each stock divided by the total amount that you invested. Make sure you press F4 to lock it. And if you use a MacBook, you can press function key plus F4. So what does it tell you? The first stock you invested 2.5%, right? So let's drag this down, right? You see how easy it is? I just drag it down, right? So this stock you have 15%, this J stock, right? So when you have, let's say you have 18 stocks and this one is a 15%, it's a little bit over weighted, right? Overweighted, but it's okay. So what is the dividend cash flow? It's gonna be how much paid per share Because if you got $0.69 per share and then you bought 300 shares, this is how much you're going to receive, right? Some of my holdings also high dividend yield stocks, and I'm very happy every time I receive a dividend, because it pays a lot. So the dividend cash flow for this stock for 300 shares, you got $200 a year. Not bad. Actually, it's pretty good. So you drag this down. You understand that this example, guys, here, it has all the stocks that paying dividend, right? There are stocks out there don't pay dividend, like Google and Amazon. A lot of companies don't pay dividend, right? So there's different investment strategies, right? For long term, you can buy those dividend kings, right? Which been paying a dividend about 2 to 3% consistently for the past 50 years, or even 25 years. Or you also have another category that is called the dividend aristocrat, right? So these are very good for long-term investments, like the oil company. Again, so what is your dividend cash flow? It's a sum of all the dividends that you have received in your portfolio. So let's think about it, right? So you invest 300K, and each year you get $5,600. This is what I call passive income. I repeat, passive income. It's dividend. You didn't do nothing. You just hold these stocks for a year. Doesn't matter. Even when the price is down, if they pay dividend, you still get this $5,600. And you see the dividend yield right here. Let's go back to the dividend yield, right? So the dividend yield, if you go to let's say stock H here is 3.44%. Right now, because the market crash in March, some of the stocks have a dividend yield is over 10%. Over 10%, guys. Okay, I'm not saying go buy. No, I'm not giving you any investment advice here, right? But understand that how you got, again, right, goes back to you got to do your own research. You know how you make money, passive income. There's so many different ways. You know how to build your portfolio now, how to select stocks, manage your risk, 1 to 5, 1 to 5. Remember the risk reward ratio. Then you got to go out and look for stocks and search stocks and then possible ETFs that you can buy and hold, right? Or trade, do some swing trade, and then, but understand that make your own practice and make this a hobby. I know you guys now cannot be full-time right now, right? Make this a hobby and it's going to benefit you for the rest of your life. Okay. All right. So now we're going to calculate the portfolio return, right? So we know, guys, we know the weight, how much you invest in each stock. Do we know each stock's holding period return right here? We know. So what is your portfolio actual return? Use sum product. The holding period return of each stock multiplied by the weight. Okay. So this gives you your portfolio return is 7.9%. 7.9% is pretty good. It's pretty good. Oh, okay. I think I said like 2%. Actually, it's a 7.9%. So this is pretty good. This is like S&P 500, this portfolio, right? Because I actually changed the numbers randomly, for today, because you have different numbers on assignment. So this is a pretty good portfolio. It performs just like the market. What is the portfolio beta? It's the weighted average beta. So it's going to be some product of all the betas multiplied by the weights of the betas. So that's going to be 0.95. Again, it's less than 1. So good job. Your portfolio is less volatile than the market. So what is the portfolio return? It's going to be the risk-free return plus the portfolio beta, which is in B20A, multiplied by the difference between market return and the risk-free return. Okay. Again, we're calculating these stuff, right? We're calculating these stuff. Of course, you can decrease the number of decimals. So to understand why are we calculating these numbers? Because these numbers give us actually a risk management, give us some perspective of how we manage our risk, and it's called the calculated risk. I repeat, it's called calculated risk and return, right? So now you have emotions. Now you have your intuitions, but at the same time, you also have these numbers supporting, hey, if I do this, what is my downside? What is my potential drawdown? What is my potential return? Hey, what's my risk reward ratio using a Sharpe ratio? It's good, let's do it. If it's not good, don't do it, right? Okay. What is the portfolio performance? Well, your actual return is 7.9. Your expected return is 9.7. Well, this one is what? Underperformed. Okay. So that's